Hello and welcome to the first of our CIMA F3 Financial Strategy lecture recaps. Okay, our first lecture is a bit of an introduction to financial strategy, so let's get straight into it. The first thing we looked at is, what does a financial manager do? He's responsible for planning three things. Investments, first of all, might be long-term investments or short-term investments. Financing, issuing bonds to do this, maybe issuing equity or using the banks. And dividend policy, how are you going to distribute all the lovely profits you make from your investments? Okay, so you're responsible for planning investments, financing and dividend policy. We then looked a little bit at the strategies a firm might follow and split them up into corporate strategies, which will focus on new markets or the current market that you're in. Business strategy, which looks a bit more closely at the business units and your competitive position. And operational strategy, which is mostly concerned with the functional areas of the business. As a finance manager, you'll be most concerned with the finance unit. Okay, we went on to look a little bit at stakeholders. Remember, these are people who have a legitimate interest in the business. We looked at internal stakeholders, might be your managers or your employees. And we looked at external stakeholders. These may be investors, the community, banks, the government, customers or suppliers. All of these people will have a legitimate interest in the business. Now, there will be conflicting objectives between many of these stakeholders. The main ones we looked at were the agency problem. Now, the agency problem, remember, is the principle of separation of powers between the owners, who are the shareholders, and the managers. The shareholders are the principals and the managers are the agents acting on behalf of the shareholders, and the objectives of these two people may not be the same. The managers want to get as much as they can out of the business, whereas the shareholders are interested in the long-term investment that they have. Okay, so that was the agency problem. We also looked at the profit incentive versus the community. Not all the time will the business be focused on the community at large. They're more interested in their profits, and that's conflicting objectives. Okay, we then looked at financial objectives. The first financial objective we looked at was the maximization of shareholder wealth, calculated by the share price growth plus your dividends. This is the key thing to remember as a finance manager. You want to maximize your shareholder wealth. Okay, the second thing you want to do is to maximize your profits. And you also want to maximize your earnings per share growth. Earnings per share, remember, is calculated by profit after tax less preference dividends over your number of ordinary shares. Okay, so those are your three main financial objectives: maximize shareholder wealth, maximize profit, and grow your earnings per share. What about non-financial objectives then? Well, they may be things such as growth, research and development, providing an excellent service, or providing quality. Okay, those are your non-financial objectives. Financial performance indicators, we look at this in more detail when we look at ratio analysis, but some ratios to get to know now are return on capital employed, which is your profit before interest and tax over your capital employed. Your dividends per share, total dividends paid divided by the number of ordinary shares will give you the dividends per share. And return on equity, this is your profit after tax less preference dividends over your ordinary shares plus reserves. Lastly, your price to earnings ratio, the market price of the share over your earnings per share. We'll look at these in much more detail during our ratio analysis section. Okay, so dividend policy. A firm has a few options when paying a dividend. It can pay a constant dividend. It can pay a constant proportion of earnings as a dividend. It can pay an inflation-linked dividend. Or it can pay what's left after it's made all of its investments. So these are the options available. We looked at a couple of theories relating to dividends. The first of which was the dividend irrelevancy theory. Remember, this was put forward by Miller and Modigliani and focused on maximising shareholder wealth. So, as a firm you have a choice. You can either pay a dividend, in which case the investors get their return in the form of income, or you can reinvest your earnings. Now in this case, as long as you make a profit on that reinvestment, this should lead to the share price growth. And what that means is that investors get their return through capital growth in the share. If you think back to our maximisation of shareholder wealth, it was our share price growth plus our dividends paid. So in this scenario, the shareholders get their shareholder wealth increased no matter whether a dividend is paid or their earnings are reinvested. So Miller and Modigliani said that dividends are therefore irrelevant. Okay, it makes a couple of assumptions though that may not hold true. The first of these is that there's no transaction costs, which as we know in real life doesn't hold. It also assumes that there's no tax difference between receiving dividends and capital growth, which again we know there is a difference between getting your income in the form of a dividend and getting it in the form of a capital growth. It will be taxed differently, so some people will prefer one over the other. It also assumes that investors are rational, which again doesn't always hold true. Okay, so that's dividend irrelevancy theory. We also look then at the clientele effect, and this simply states that you should choose one of these methods of returning your dividend and stick to it. Okay, so that way people know whether you're going to return a dividend in the form of an actual dividend or you're going to reinvest it to increase share price growth, and that will be dependent on the tax preferences. Okay, you'll have a consistent policy as to which one you're going to do, and the investors will then choose whether to invest in you if they want whatever you're providing, or to invest in someone else who's providing the return in a different way. Okay, so that's the clientele effect. The bird in the hand arguments that investors want their return now, and they're not interested in capital growth or reinvesting the dividend. They want their dividend paid on the basis that it's better to have the return now rather than face uncertainty in the future. That's the bird in the hand argument. Okay, remember when you're paying a dividend that there'll be a signalling effect to the market. If you were, for example, to pay a reduced dividend, the market may assume that you're in financial difficulties. If you were to pay no dividend at all, they may think that you're close to bankruptcy. Or if you pay a rising dividend, they may assume that the business is very strong and able to pay a dividend in the future. So that's the signalling effect. What signals are you giving to the market with your dividend? There were some ways then to return non-cash dividends. First of these is a bonus or scrip issue. Now this simply means that you pay in the form of shares. People get extra shares instead of a cash dividend. Another way to do this is a share repurchase, simply buying back some of the shares that you have issued. Why would you do this? Well, you might want to reduce the size or the capitalization of the firm. You might want to increase your earnings per share by reducing the number of shares. You might want to alter your gearing ratio, or you might want to use up some surplus cash that you have. How do you do this? You can either go to the stock market simply and buy the shares like anyone else, or you can go to your institutional investors and buy the shares off them, or you can put an offer to your shareholders. Because remember, some shareholders then will get a good price for their share and may want to sell. Okay, so the next thing that we looked at was not-for-profit organisations. Remember, these are a little more difficult to have objectives for, simply because the profit incentive isn't there. And we looked at how to use a value for money analysis to assess how they perform. This looked at the 3 E's: economy, efficiency and effectiveness. And if you have a not-for-profit question, the way to approach it is to use these 3 E's as headings and discuss the question. Okay, so that was our introduction to financial strategy.